What are the difference between assets and liabilities? There is virtually no distinction between assets and liabilities. Things that put money in your pocket are assets. Liabilities are items that drain your bank account. It goes without saying that you want to accumulate as many assets and as few obligations as you can. I'll explain how to increase your asset holdings while reducing your liability exposure. Hello everyone, welcome to Finance Wisdom. In this video, we're going to talk about what are the difference between assets and liabilities. If you're new to this channel, do like and subscribe to the channel. Liabilities and assets should not be confused. In financial accounting, an asset is defined in a relatively straightforward manner. Anything that can be used to create value, and by value, I clearly mean money, is considered to be valuable. But many people often fail to distinguish between the two. Here's a prime illustration. Is a home an asset? Some people believe that purchasing a house is an asset, but unless you intend to sell it, it is really a burden and a sizable one at that, due to the mortgage and the ongoing maintenance expenses you will incur on a regular basis. It will drain your finances for years to come. If you ask me, it is not money in your pocket. On the other hand, the property might be seen as an asset if you intend to sell it again for a larger sum. If you pay to obtain assets, you may also refer to them as investments. Why? Considering that investments are anything that offers a quantifiable return on an initial investment. For instance, buying stocks, shares, or bonds counts as an asset acquisition, since you may sell them for a profit via capital gains or dividends respectively. Later, we'll clarify it. Is a vehicle an asset? When you decide to purchase an automobile, the price drops significantly. It would be ridiculous to think of used automobiles as assets, since they are worth far less than new ones. Many still argue that because you may subsequently sell the automobile, you can see it as an asset in this regard. In my opinion, a good asset must also be profitable. An asset is not something that quickly loses value, such as a vehicle. You won't be profitable whether you sell it 2 hours after purchasing it or 2 years later, since you won't be able to sell it for more money. There are of course certain exceptions. There are vintage or rare automobiles whose values may rise. We're not discussing such uncommon instances. We're discussing the kind of vehicle that most individuals purchase, a daily driver for personal use. That's the difference between assets and liabilities. What separates tangible assets from intangible assets? This one is very simple. You can touch and engage with tangible goods because they are real. Tangible things examples include real estate, home furnishings, financial inventory, and so on. You cannot physically touch intangible assets since they are not physical. Brands, patents, copyrights, and other items, as well as financial and actual assets, are a few examples. Real, financial, and material assets are often conflated and not distinguished. Real, financial, and physical assets are often grouped together as if they are the same thing and produce the same amount of profit. But this is not how things really function. Real assets, to put it simply, have worth. The reason they are known as real assets is that their intrinsic value represents an asset's true worth independent of market forces. Financial assets are valued according to market trading prices, so it is possible to pay more for something than it is worth, which is bad since you will lose money. This is another reason why experts like Warren Buffett often discuss determining a company's intrinsic value in order to determine if a stock is being sold for more than it is really worth. If the market price is less than the inherent value, you will almost certainly make money later on when it approaches or surpasses the intrinsic value. Contrarily, the value of financial assets is derived from contractual claims. In a moment, stocks and bonds are two examples. I'll explain why they're considered physical assets in a moment. It is simpler to turn financial assets into cash. Real estate and commodities are more difficult to monetize. Stocks are the mother of all assets. If you don't know how they operate, I'll explain it to you in such a straightforward manner that you'll understand them by the conclusion of this video. The most well-known asset is a stock, which has great potential for investors who understand how to use it. Stocks, sometimes known as shares, represent a portion of a business. In essence, when you purchase a share, you're purchasing a very small portion of the firm. Imagine owning a home and being able to purchase a single brick. Because you own that brick, you have a right to it, and you are a member of the household. You ask, why on earth would you want to possess a brick? First, I want you to know that when you purchase stock, you essentially become a part owner of the firm if you own enough shares, which equates to a larger ownership stake. You could also be able to cast a ballot when a crucial decision is being made by a business. If you like this video, don't forget to like and subscribe to this channel. Let's now continue to discuss the difference between assets and liabilities. Stocks may be profitable in two different ways. There are primarily two ways to earn from stocks. Capital gain is the first and most typical. This implies that you purchase a stock, wait for it to appreciate in value, and then sell it. For instance, you may buy a stock for $4 and sell it for $6. If you were to earn a $2 profit, everything would be okay. Depending on the market supply and demand, prices may increase or decrease. The higher the demand for a stock, the higher its price. Therefore, if you believe that a stock will become more in demand in the future, you should acquire it since its value will increase, allowing you to sell it for a better price. However, you should exercise caution if your projections prove to be inaccurate and the price declines instead of rising. Money will be lost. Many people see this as a risk, but if you know what you're doing and carefully assess the businesses you acquire, you should often come out ahead. The second method to profit from stocks is via dividends, which are paid out annually, semi-annually, or quarterly. The equivalent of your equity in that corporation is dividends. Going back to the brick example, if you purchase one brick out of 100, you will get 1% of the house revenues. So far, it makes sense. How can I buy stocks? Opening an account with an online stockbroker for investing is the simplest method to achieve this. These services are likely also provided by your bank, so you may be able to invest conventionally there. Every transaction is controlled and taxed, since fees are involved in both situations. It is far more difficult to purchase straight from the corporation, but you could. Both time and money are necessary. Real estate may sometimes be considered a separate asset. I say in certain circumstances because, as I said previously, buying a home to live in for the remainder of one's life without intending to sell. It is a cost, not an asset. Although some real estate speculators buy underpriced property with the intention of renting or selling it later, at which point it becomes an asset. In principle, this one should be pretty straightforward, but in actuality, things are rather different. As a real estate professional, you begin each day by hunting for intriguing offers on underpriced homes. How do you define underpriced? It indicates that you are searching for something that has been mishandled for a long time, but has a lot of promise. As a result, the price is modest even if it may need some repairs. You're going to take care of those problems and sell the house again for more money. By fixing problems, I mean making any improvements to the property that would increase its value, such as updating, painting, or furnishing. The cost of a property is influenced by several things. It's not only a matter of management. Just a few examples include time, place, economic indicators, and interest rates. You might also fix the home and rent it out rather than sell it. This will guarantee a monthly infusion of additional money. Realistically, there are many different sources of property, including residential, commercial, industrial, raw land, and special use. However, you probably lack the resources, assurance, and expertise necessary to purchase, rent, or sell property. Most likely, you are not even sure where to search. Does it imply you can start purchasing these sorts of assets? First off, you can always pick up the necessary skills. Another possibility is to use REITs to buy real estate investment trusts. You wouldn't need to be an expert. All you would need to do is trust a corporation to invest your money in real estate and return it to you with a dividend. Many contend that these are excellent investments since they provide large dividend yields and long-term appreciation, which means that prices rise and you are able to fend off inflation. Is knowledge considered an asset? In truth, knowledge is an intangible asset. Its status as an asset may be explained rather simply. Let's imagine that you are the owner of a marketing firm. What you do is quite easy. Through internet marketing, you assist companies in gaining more customers. You determine everything, including marketing tactics, approaches, and techs. You need to delegate, since as the creator of this flourishing company, you can't handle everything yourself. The first step is to appoint an accountant and a financial advisor to handle that aspect of the firm. Then you begin employing content producers. They are required in order to produce the marketing-related material. Then, in order to bring in even more customers for your business, you must employ skilled salespeople. They are expected to accept leads and turn them into customers. You'll earn more money if you recruit better salespeople. See where this is headed? If you invest in employing brilliant individuals who have a knack for selling, you have a valuable asset. It just turns into something you're going to use to increase your income. Additionally, the return on your investment is unquestionably quantifiable, since you can simply figure out how much to spend each month or how much commission a salesperson earns. And the value of their expertise is determined by how much money they generate. What does it mean for you? Since it's rare that your firm needs to recruit new employees, here's the deal. If you master a useful talent that you know entrepreneurs need to expand their businesses, you might end up being an asset. Learning is essential, and you'll be paid more the more knowledgeable you become. We've reached the end of another video, and thank you for watching. I hope you have learned the difference between assets and liabilities. If you like this video, do give us a like, subscribe to the channel, and comment down below. Thank you and goodbye.